So the question on most people's minds, from what I can tell, is, oh my God, inflation is killing me. My portfolio's hurting. I need something with yield. I need dividend. We got to get dividend because at least I get dividend. And you got to tell me what REIT to be in. We've got to get into some REITs. REITs are the answer. What's the best REIT to be in for 2022? The Fed's going to kill us. The Fed is killing us. That's the central bank Fed. So what should we do? So we're going to talk about today, we're going to talk about the Fed. We're going to talk about what is the best REIT to be in and what is going on with inflation. Stick around. Hey everybody, this is RC Peck, and this is my weekly update. And I want to talk about three things today. I want to talk about REITs, I want to talk about inflation, and I want to talk about reading headlines, and they are all combined. So what I'm going to do is I want to jump over to the price charts, and we're going to jump into this. So let's go to, all right, there we go. So this is just VT. It is a price chart of the whole world stock market. The US represents about 60% of the world's stock market, which is crazy because it's only 4% of the world's population, and it's 24% of the world's GDP, but it represents 60% of the world's stock market. Think about that. I'll just let that sit there. So the market's in a downtrend. Stocks are in a downtrend, and pretty much wherever you are in the world, even if you're in Canada, let's just throw a price chart up of Canada here, because Canada is doing pretty good. Let's just call that sideways. Australia is doing pretty good. We'll call that sideways to a little down. But basically those are really two stock markets that are holding up best around the planet, which makes sense because they export a lot of commodities. So I've been hearing a lot about REITs. So I just typed in to the old Google, best REITs, top REIT ETFs, best REIT ETFs. And I get this GoBankingRates.com article, 3 best REIT ETFs to buy in 2022. Oh, okay. Now I've been told that you need to have REITs when inflation's high. By the way, that's not me, that's someone else talking. That's how people have been taught to think. And so this article says, oh, you got to get VNQ, right? Let's get VNQ, or maybe let's get XLRE. Hold on, we're already on 3, 2. Or Charles Schwab's US REIT, SCHH. So let's go look at these 3 here, and let's see what these 3 REITs are doing. So let's put in VNQ here. So there's VNQ. Now this price chart already includes the dividend being reinvested. So it's like, hey, it's got a dividend, so I guess I should be all high-fiving myself. But I think your brain can probably see that the high, and then the high got lower, and the lows are getting lower. Your brain can start to see that that pretty much looks like a downtrend to me. You don't have to be in something. You don't have to be in something. Maybe your big box advisor has told you you have to be in something. Now, if you're going to be in something that's going up, right? It's okay to be in something, but have it be going up, especially when the rest of the world is not going up. And then the article said, well, maybe it's XLRE, which, by the way, everyone looks exactly the same. This is XLRE. Looks exactly like VNQ, which I think is kind of funny. That this article is going to show you 3 REIT ETFs that visually look exactly the same. Now, as you know, I'm a dyslexic. So when someone says something to me, the first thing when someone says something to me about the stock market or the investment world, I go look at a price chart because I want to know if they're actually doing something different. And then here's the other symbol. Oh, look, it's the same looking price chart. Here is SCHH. So now I don't know what GoBankRating.com, let's see what it's called, GoBankingRates.com. The point is it was one of the first links to come up when I put in best ETFs of 2022. Maybe I just put in best ETFs. And this came up. It looks really nice. It's pretty. It's got a layout. It's got a smiling guy here. He just closed on his, looks like he probably sold a house to someone. He's super happy. right? So we easily get hijacked. But the key is to actually look at the price charts and be like, well, I don't want to own something that's trending down. That doesn't make me wealthier or happier. So I went over to ETF database, which of course they had to rename themselves VetaFi. It's very annoying. So etfdb.com didn't change the website. I just went to go look at all their their REIT ETFs. I know it says real estate ETF, but these are all their REIT ETFs on here. And the only ones that are positive are inverse real estate ones. Everything else on here is losing money. Now, the best one is VRAI, only down 2%, but still, I don't want, let's just go look at what VRAI is. VRAI. So there's VRAI. I don't know what this is. I'm not recommending anything. These videos are not about recommendation, but it's actually down for the year, including its 3% dividend. But, probably the best looking virtual real asset income ETF. I don't know what is actually in it. But the point is, people are getting hijacked. They are freaking out because of inflation. And you have to ask yourself what your inflation is. I'm not saying you don't have inflation, but what's your inflation? And if you're in the stock market, or with your money that's in the stock market, if it's not losing, that's good, right? People are getting hijacked like, oh my God, I have to do something because inflation's 9% and that's eating away at my money. It's like the stock market's down 20 to 30% this year. I think it's falling faster than inflation. And if you just stay out of the stock market or have parts of your money out of the stock market, or you're stepping out of the stock market, then you're protecting yourself. So people are kind of conflating the two things. And then there is another article called the 12 Best REITs to Buy. Now, these are individual companies. Sorry, these are not ETFs. These are just individual REITs. So one would be American Tower right there, American Tower, which is AMT. There's AMT right there, which like, okay, it doesn't look that bad. It's only down, I'm not being facetious, it's only down 13%, right, this year. You don't have to buy something. You don't have to do something with your money. It's okay to be in cash. Know why you're in cash. Have a system that stepped you into cash, which can be reversed so it steps you out. That's what you're looking for. DLR was another one on that list. DLR. Again, same thing. People are not taught to think with their eyes when it comes to investing. And so what happens is people are probably buying Digital Realty Trust right now, which is a REIT, has a bigger dividend than the S&P. But as your brain, I'm going to do it right now, as your brain can see, DLR is down 20% this year. That's 20%. So if you're feeling like you have to do something, it's either because you own 50 to 100 symbols and they're all falling and your advisor is kind of doing the old, it will come back and the market always comes back, which is true. And that's okay if you're 27 years old, but when you're 57 or 67, you do not want to wait 5 to 15 years for the market to come back. Okay, and then we have the federal funds rate. And so the question is, now I should probably zoom way out on this. Let's just go way out on this and let's clean this price chart up a little bit. So here's the federal funds rate right here. I actually want to zoom out even more. That's only 35 years, everyone. Okay, now, and actually, I know, stick with me here. That's a logarithmic chart. Let's show it non-logarithmic because that actually tells us the true story of what's going on. So the Fed is going to raise rates and it's raising rates. And if you look at the price chart, you can tell that the Fed raises rates and then they lower them, but they never raise them, never. I'll take that word in a second. They never raise them more than they raised them in the past. So over the last 40 years, let's call it 38, 81, it's ended. So we're about 42 years after 1980. So the bond market stopped going up about 2 years ago. That means when bond prices stop going up, they are going down. And the bond market moves in these 35 to 40 year kind of cycles. So it's very likely we can see bonds down for the next decade. But if you look at the screen, you see the Fed has already started raising rates. So here's what I believe. I believe the Fed's going to fight inflation, meaning they'll keep increasing rates, okay? And as long as the economy is good enough, how about that for an economic term? As long as the economy is good enough, the Fed's not going to do anything. Let me actually get out of this right here so you can see. So the Fed's not going to worry about the stock market. So let me just say that right now. Now, I know we've had all these comments like the Fed put, like if the stock market falls too much, then the Fed's like, okay, I got it. It fell too much. Fed's not going to do that. The Fed does not care about the stock market. It cared about it before, but it does not care about it right now. So it will absolutely fight inflation, and it does not care maybe anymore, or at least right now, about what the stock market is doing. It's willing to crush the stock market to fight inflation, and inflation is a problem for them right now. And they're behind. So if we could put let's do this, and I'll show this to you in a second. I know you're not seeing this, but let's put in UST 2-year. So I have two price charts here. So the bottom one down here, you can see I'm at the bottom one. That's the yield on the 2-year Treasury. And you can see it's already at the same level it was at the end of 2018, which just for easy math, let's call it 3%. So the 2-year Treasury, the yield on the 2-year Treasury is already back to 2018 levels. Okay, now if we go up here, you can see the federal funds rate is nowhere near being at 2.5%. So they're going to go to 2.5%. And as long as there's strong enough growth in the economy, and maybe even if it starts to weaken, and maybe even if it starts to just get a little negative, they're going to still be pushing to 2.5%, because you know what happens after they raise rates. They have to then lower them again. It's absolutely ridiculous. So then they'll probably lower them again to 0. If they do that, then bonds may actually go up. But I want to get clear about what the takeaway is from the video this week. You don't have to do something. If you're deliberately in cash and you're owning something that is trending higher, that's okay. It's okay to be in cash right now. I know gas is at lifetime highs in the US. It's going higher. It's absolutely going higher. Exxon is going higher. Energy is going higher. Oil is going higher. Natural gas is going higher. That's not even that too big of a prediction. Those are going higher. Now, there'll be some corrections, and it would not shock me if energy goes higher for the next 8 more years, but let's just stick with the next 6 months. So that's the first thing. You don't have to do something. The second thing is there's inflation, and then there's what your stock market money is doing. People are telling you to rush into REITs. Gotta get a REIT. Gotta get a REIT. You don't have to do anything. Now, people who may be feeling like they have to do something, it's because they own 30, 60, 90 symbols, and their portfolio is absolutely out of control right now. But if you only have a few symbols, then you can manage that portfolio well. And it's okay to actively, how about this? Actively be in cash. Deliberately be in cash, even if it's making you 0. 0 is much better than negative 5% or negative 10% or negative 20% or negative 40%. It is a much better investment. And there are these periods of time, shorter periods of time, where cash is the absolute best thing to own. Thanks for being in my world. I do appreciate you watching. I appreciate you listening. Please share this video. It helps. Hit the like button. Leave a comment. Where do you think I got it right? Where did I get it wrong? What did I miss? Or what am I missing? And if you like this, you're going to like our other videos too. So thank you for that. Also too, we manage people's money in a powerfully simple way. A way where you understand it, you can follow it, you can transfer it, you can get what's going on with it. It's a very, very different way from any other big box advisor. Typically, the person who does hire us, they're on their 2nd or 3rd big box advisor, and they're starting to say something's wrong here. They don't need another big box advisor. We truly are. I always say to people when I manage money in a very odd, weird way. It's a way that you can absolutely understand it. Thank you for being in my world. I appreciate you, and I will see you on the next video. Okay, bye.